Good morning and welcome to our Valley series on tax planning, year-end tax planning webinar for individuals, hosted by PKF O'Connor Davies. All attendees are in listen mode only. Before we get started, I'd like to go over a few housekeeping items so you know how to participate in today's call. We've taken a screenshot of the attendee interface, and you should see something that looks like this on your own computer desktop in the upper right corner. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the webcast. We have a lot of material to cover, and if time permits, we will make an effort to respond. If we cannot get to your questions, a response will be sent post-event. This webinar is offering 1 TPE credit in taxes, and you will need to respond to 3 of the polling questions to receive credit. If you are having difficulty responding to a question, it is recommended you come out of full screen mode to respond. CPE certificates will be issued within 8 to 10 days via email. A recording of today's webinar and a copy of the PowerPoint slides will be made available to you via email a few hours after the event. At the end of the webinar, we do have a very short survey which will be prompted, and your response is greatly appreciated. At this time, I would like to introduce Chris Migliaccio, partner with PKF O'Connor Davies. Chris?
Thank you, Harleen. Welcome, everyone. Today, we're going to be talking about year-end tax planning for individuals. We're going to go through some best practices, things to consider. I always remind people sort of nothing is one size fits all here, but want to present to you, what we're seeing, what we've been thinking about, and what we're seeing is sort of the best options out there, so you can start thinking about your year-end planning with a couple of months to go. Joining me today, Richelle Maguire, Megan Heegan, and Nick Rochedieu. And I'm going to send it over to Richelle to kick us off.
Great, thanks, Chris. So just to go over our agenda for today, we're going to talk about just getting an understanding of the tax rates applicable to individuals. We'll review some planning related to investing and charitable giving. We will discuss retirement plan options and contribution limits. We'll revisit the continuing provisions of the Secure Act. We'll address the relevant provisions of the new Inflation Reduction Act. We'll provide an estate and gift tax update. We'll highlight the new Corporate Transparency Act, talk about what's going on at the IRS, consider what's ahead, and end with a review of state and local tax considerations. So with that, I will turn it over to Megan to get us started.
Okay, good morning, everybody. There's actually not much new for 2023, especially with regards to tax rates, except for the inflation adjustments. If you go to the next slide, yeah. So the current rates range from 10% to 37%, depending on income and filing status. And the next time we're likely to see changes is when the Tax Cuts and Jobs Act expires after 2025. So starting in 2026, the highest tax rate is set to revert back to 39.6%. Our tax system is progressive, so income is taxed at the different rates as you move through the brackets. So not every dollar of your income is taxed at the top rate. And that top rate kicks in at about $578,000 single and $693,000 married filing joint. Long-term capital gains, qualified dividends gets the preferential rates, 15% or 20% for higher income taxpayers. Net investment income tax is an additional 3.8%. Self-employment tax rate totals 15.3%, and the Medicare surtax of 0.9%. The AMT rate is 28%, but with the increased exemption amounts and phase-out thresholds from TCJA, we are seeing less taxpayers subject to the AMT, but again, that is set to expire after 2025. So what can be done to reduce your tax rate? Next slide. Before year end, you should consider your capital losses that may be available. If you go to the next slide. Utilize capital loss carryforwards. Make sure you're aware of what you have available in 2023 so that you can plan to offset any potential capital gains. Consider loss harvesting. You may have assets that have declined in value that you want to generate losses before year end, but be mindful of wash sale rules. You cannot take a loss if you repurchase the same or substantially the same security within 30 days. Do you have any worthless investments? If you have stock or other investments that have become completely worthless in 2023, you can claim a capital loss equal to your basis. Do you have any non-business bad debts? If you've loaned money and you don't reasonably expect to collect it, you can claim a short-term capital loss. If you'll be receiving proceeds from a sale over multiple years, you can use the installment method to defer a portion of your gain. In most cases, that makes sense, so you can spread the income over multiple years. In some cases, it may not make sense. For example, if we're expecting capital gain rates to increase. Netting rules. So net short-term capital gains are taxed at the same rate as your ordinary income, while long-term gains are taxed at the reduced 15 or 20% rate. So to the extent that you have short-term gains, you'll want to offset them with available losses. Short-term losses are first applied to short-term gains, long-term losses first applied to long-term gains, and then they can be used to offset each other. If you have an overall net capital loss, you can deduct up to $3,000 in the current year, and the remainder carries forward. Gains and losses. Okay. Gains and losses from sales or exchanges of cryptocurrency must be reported whether or not you receive a tax form reporting those transactions. Qualified opportunity zones. Another opportunity to defer the recognition of a capital gain is by investing in a qualified opportunity fund, which invests in designated lower income areas. And that gives you the opportunity to defer your original capital gain until 2026. And if you hold the qualified opportunity fund investment for 10 years, any gain from the appreciation of the investment is tax-free. Qualified small business stock. So when qualified stock is sold, you can exclude capital gains up to 100%, depending on the facts. The small business has to meet certain requirements, such as having gross assets of 50 million or less. You must hold the stock for at least 5 years. And if all other requirements are met, and the stock was acquired after September 27, 2010, you can exclude 100% of capital gains when sold. Assets acquired before 2010 may be eligible for 50 or 75% exclusions. Next slide. Polling question. Do you invest in cryptocurrency?
You know, one thing I think is interesting with cryptocurrency, Megan, that you noted, is that you have to report it whether or not you get a tax form, right? I do think there's kind of an interesting question as you're getting towards year end, if you're investing in crypto, right? In how you keep track of that. So have you seen any best practices in terms of keeping track of your crypto gains and losses?
Yeah, I think that even if you may not get an official tax form, I think that within the accounts there are you can generate reports that will show the activity that if you provide those to your tax advisor, they can.
I'll chime in here. Having more than a couple accounts, usually some of them will actually do almost like a 1099 type statement. Other ones you actually just have to go in and download all of your activity through the year. So it's decent data, but not perfect. So whatever you're buying and selling, I always tell people it's worthwhile to keep track of it throughout the year.
Like most of our attendees don't invest in crypto, though. So we'll move on to the next topic.
Okay, next slide is charitable planning. So charitable giving is another way to reduce your taxable income. If you go to the next slide, there's various AGI limitations. Generally, cash to public charities is fully deductible up to 60% of your AGI. Gifts of appreciated property up to 30%. To keep in mind is that charitable donations are only deductible if you itemize your deductions. So if you don't have enough to itemize and you're taking a standard deduction, you're going to lose that benefit of the charitable contributions. In 2023, the standard deduction is $13,850 single and $27,700 married filing joint. So if you expect to itemize in 1 year and possibly not the next, you can bunch your contributions into 1 year. If you prefer to give throughout the year but want to make sure you get the deduction up front, you can donate to a donor advised fund, and you'll then get the deduction at the time you make the contribution, and the funds can then be distributed from the donor advised fund at your discretion. You can also contribute to a private foundation. The AGI limitations are a little bit lower. Cash is deductible up to 30% of AGI and appreciated property up to 20%. Gifting appreciated securities is valuable since you get a deduction for the fair market value of the asset, and you also avoid the capital gains tax that you would have incurred if you sold the asset. If you gift property in excess of $5,000, keep in mind that the property has to be appraised by a qualified appraiser. An appraisal is not required for publicly traded securities, but it is for contributions of cryptocurrency. Another way to contribute to charity and reduce your taxable income is by making a qualified charitable distribution directly from your IRA. You can directly transfer up to $100,000 per year from your IRA, and that will also count towards satisfying your required minimum distribution. And be sure to keep good receipts for all donations. Next slide. Oh, another polling question. What cause are you most charitably inclined to support?
A lot of good ones.
Yeah. Another thing with the donor advised fund to keep in mind, like if you're not sure exactly where you want to make your contributions, but you're getting towards the end of December, that's another good reason to use. You can make a big contribution into a fund and then decide where you want to direct those contributions later.
Yeah, I think it's also important to try to think about, again, if you're having a bigger year, that's exactly when it's the time to make those charitable deductions and not wait, because then you kind of lose some of the advantage that higher AGI you have in 1 year. A great time to make a larger charitable donation.
Exactly. Mm-hmm. Oh, pretty even. Okay. So next is retirement plans and contribution limits. So retirement plan contributions can also reduce your taxable income. There are various contribution limits, which are listed on the next slide. It's important to remember that if you contribute in excess of these limits, you can trigger a penalty from the IRS. So before making contributions, consult your tax advisor, especially if your income fluctuates from year to year. Some plans available: self-employment retirement plans, IRAs. You can make deductible or non-deductible contributions to IRAs depending on whether you're covered by a retirement plan at work and income limits. If your children have earned income, they can begin funding IRAs early in life. Roth options. So Roth IRA contributions are not deductible, but withdrawals are tax-free. Not everyone is eligible to contribute directly to a Roth because of income limits. There is the ability to convert a pre-tax retirement account into a Roth, but at that time, the full conversion is taxable. So when considering a conversion, you'd want to look at your tax rate now versus your expected tax rate in the future during retirement, the potential for tax rates to increase, when you plan to start taking distributions, and we can go through those scenarios. Under TCJA, you can no longer recharacterize Roth conversions. So once the conversion is done, it can't be reversed. Required minimum distributions. So you generally must start taking withdrawals from traditional IRAs, SEP IRA, and retirement plan accounts when you reach 73. Roth IRAs do not require withdrawals until after the death of the owner. Next slide. As I mentioned, there's various contribution limits. They're summarized here. IRA, $6,500, it's $7,500 if you're over 50. Spousal IRA, keep in mind that if you file a joint return and have earned income, both you and your spouse can contribute to your own separate IRAs, and it doesn't matter which spouse earned the income. As I mentioned, Roth IRA, not everyone can contribute. The phase-out limitations are right here. 401k limit, 22.5 with a catch-up for 50 plus, and SEP IRA limited to 25% of compensation or 66,000. And next slide, I think we're moving over to Richelle.
Thanks, Megan. So the Setting Every Community Up for Retirement Enhancement Act, or more easily called SECURE, was enacted back in January of 2020 and was followed up by a second version titled SECURE 2.0, which passed in December of 22 as part of President Biden's year-end spending bill. The original SECURE Act raised the required minimum distribution age that Megan just mentioned up to age 72, and SECURE 2.0 further increased that minimum age to 73, with applying to people turning 72 through the end of 2032, and then that age will increase to age 75 for anyone turning age 74 thereafter. The SECURE Act also removed the age limitation for making IRA contributions. It provided for penalty-free withdrawals from IRAs and 401ks to help pay for childbirth and adoption expenses. One of the most significant changes in the Secure Act was that requires inherited IRAs and 401ks to be withdrawn within 10 years of the owner's date of death. As a result of that, we're seeing a lot of Roth conversions because, as Megan mentioned, they're not required to be distributed until the owner passes. And when they come out, they're tax-free. So we're seeing a lot of people not wanting to leave this and a taxable IRA to their heirs and force them to be withdrawn over 10 years and put them into a high taxable situation. The Secure Act also allowed for 529 plan beneficiaries to use those funds to pay down up to $10,000 of qualified student loan debt, which was not available previously. Next slide. Next slide. More recently, the Inflation Reduction Act, this was passed in August of 22, and it covers new and reinstated tax laws that focus on clean energy and climate change. This act is primarily oriented towards the business sector. However, there are a few individual provisions incorporated, including the Clean Vehicle Credit, which is a $7,500 maximum credit. However, this is subject to taxpayer income limitations as well as manufacturers' suggested retail price limitations. The act also included a new tax credit for previously owned qualified clean plug-in and fuel cell vehicles, which is limited to the lesser of $4,000 or 30% of the vehicle's purchase price. The act also extended the energy efficient home improvement tax credit through 2032. This qualifies for 30% of qualified expenses, but is subject to pretty low limits. So while it sounds like a big tax benefit, the actual limits are only a few $1,000s. So taxpayers are often surprised at the minimal benefit they get for their home energy improvements. And while not a tax incentive, the act also includes prescription drug pricing reform. And whether this is a tax incentive or a detriment to individual taxpayers, the act also included substantial funding for the IRS to do a major overhaul of their systems and their staffing in order to improve taxpayer services, but also to increase enforcement of tax laws. So we expect to see a lot of activity there as that progresses. Next slide.
Okay, it's back to me. So estate and gift tax update. We could spend a lot of time on this topic, but we're just going to highlight a few of the items and identify what's on the horizon. So the annual gift exclusion, $17,000 in 2023. You can give up to $17,000 per person to as many people as you like without those gifts counting towards your lifetime exemption. 529 education plans, you can actually gift $85,000 upfront and spread it over 5 years without incurring any gift tax or reducing your lifetime exemption. So you can get that money in the plan earlier so that it can, begin to grow. If you make payments directly to educational organizations or medical care providers, they do not count as gifts. Next slide. So, this is important. The TCJA doubled the lifetime exemption starting in 2018. The 2023 exemption is $12.92 million per individual, and it's scheduled to go down to $6.2 million per individual after 2025. So if you haven't yet considered maximizing your exemption, now is a good time to think about it. We don't know what the tax laws are going to be in the future, so making gifts now guarantees your use of the higher exemption and the future appreciation of those gifts outside your estate. If you've already maximized your exemption in 2022, you can still gift an additional $860,000 in 2023 since the exemption was indexed for inflation. The $12.92 million is per taxpayer, so it doubles to $25.84 for a married couple. Spousal transfers, you can give unlimited gifts to your spouse who is a U.S. citizen, and non-citizen spouses, you can gift up to $175,000 in 2023 without having to pay gift tax. Next slide. With regards to your estate, now's a good time approaching the end of the year to review your estate plan documents. make sure your assets are titled correctly, review beneficiary designations, especially in retirement accounts and things like that. Consider state income and estate tax implications, upstream planning. So when you gift low basis assets to your children, you're able to use your exemption and the assets continue to appreciate outside your estate. But what they don't receive is a step up in basis at your death. So when those assets are sold, there can be large capital gains to the recipient. This could be a potential planning opportunity to gift low basis assets to either a parent or grandparent if they're expected to have a non-taxable estate. The assets would then receive a step up in basis at their death, reducing or eliminating the capital gains to their beneficiaries, which would be set up to be you or your children. So there's, many options, trusts, a lot of things to consider, but it's a little bit out of the scope of this presentation. So just wanted to mention those things. Next.
Okay, next slide. So the Corporate Transparency Act, this is not really new. It was enacted by Congress back in January of 21 as part of the National Defense Authorization Act. And it includes significant reforms to anti-money laundering laws and is intended to help prevent and combat money laundering, terrorist financing, corruption, and tax fraud. The act actually goes into effect on January 1st of 2024. So the date's coming right up in just under 60 days now. And what it is we're going to require reporting to the Financial Crimes Enforcement Network, otherwise known as FinCEN, which is a bureau of the U.S. Department of the Treasury. Next slide. The relevant parties to the filings are reporting companies, beneficial owners, and company applicants. Now, as this is not, this applies to entities, and so is not an individual compliance requirement. So we're not going to go into the detail of who might qualify in each of these categories, but we wanted to bring this to everyone's attention because many individuals will be classified as beneficial owners. And we wanted to raise awareness as you may be asked to provide personal information to comply with these new reporting requirements. Next slide. So we're still waiting for the reports that are going to be filed are called beneficial ownership information reports. And we're still waiting for more information as the forms are still under development. So we haven't even seen what they look like. And there's been no guidance to date on how these will be processed and filed. But what we do know is that these reports will require a reporting company to identify itself and report the following information about every beneficial owner: their name, their date of birth, their address, their unique identifying number, i.e. your social security number, and a copy of an identification document such as a valid driver's license or your passport. Now, in the interest of identity protection, you can choose to submit these items of information directly to FinCEN and obtain what's called a FinCEN identifier, and that can be provided to the reporting company in lieu of your personal information, so that you're not giving your personal information out to anyone and having it float out there. So that's something that we will likely be recommending to our clients. Next slide. So as I mentioned, the effective date for the rule is January 1st of 2024. However, companies that are in existence as of that date will be granted a 1-year extension until January 1st of 2025 to file their initial reports. Any companies that are created after January 1st, 2024 will have 30 days after their creation or registration to file an initial report. Reporting companies going forward, once they've initially filed, will also have 30 days to report any changes to information that's been previously filed and or to correct information that's been erroneously filed. With that said, on September 27th of 2023, just a few weeks ago, FinCEN did propose amending the reporting rules to extend that 30-day window to 90 days only for entities created during 2024. Vincent indicated that the goal of the extension is to provide more time for new companies to understand their obligations, gather the necessary information to do so, and to resolve questions related to the filings. Next slide. So be aware that the first thing you'll see that comes up on the FinCEN website is already an alert. Not surprisingly, cyber criminals are already using this as a phishing opportunity to solicit personal information from individuals. So we want everyone to be aware, be cautious. Do not provide your personal information or click on a link or scan a URL without verification. Next slide, please.
Okay, what's going on at the IRS? Next slide. More of the same when it comes to processing delays and extensive wait times. Taxpayers will have the option to go paperless for IRS correspondence by the 2024 filing season. The IRS encourages all taxpayers to obtain an identity protection PIN. You can do that through the IRS website, and you use that PIN on your tax return, and it prevents someone else from filing a tax return using your social security number. We've been seeing that happen more often, so we think that's probably a good idea. The IRS has also been ramping up efforts to pursue high-income, high-wealth individuals who've either not filed or failed to pay. And the IRS has also been implementing artificial intelligence into audits. So we'll see what that looks like. Next slide. Polling question. Do you think the IRS will be paperless by 2025? We can hope.
I will say my vote here would be no. I'm not optimistic. Although I think it's a very good thing that they're trying to move forward on that. I think there's a lot that can be done, but there's a long way to go. So 2025 is only 14 months from now. So we'll see.
Yeah, I mean, $80 billion of funding, you got to imagine they've got to be able to move something forward.
Everybody agrees.
Well,
Some people are optimistic.
1 in 10 people have the optimism here.
They're definitely not CPAs.
Okay, so what's ahead? Next slide. As I mentioned, a few times, the Tax Cuts and Jobs Act is expiring December 31st, 2025. So various provisions are set to revert back to pre-TCJA levels. As I mentioned, the gift and estate tax exemption will be cut in half. The top individual tax rate will increase to 39.6%. Some other items are scheduled to go away, including the 10% cap on state and local tax deduction, the increased child tax credit, and the qualified business income deduction. Standard deductions will decrease. The AMT exemption phase outs will also decrease. So all of this is uncertain right now. The expiring provisions could potentially be extended or modified. There could be new tax legislation, and we have a presidential election on the horizon. So your guess is as good as mine. I think we have Nick next with some state and local considerations.
Excellent. Well, appreciate it. If you go to the next slide. First, and I guess I'll say two quick things on the credit side. There are federal credits out there, a lot for energy efficiency, and I would say if you do have a state credit, just take a look. Something to look into prior to the end of the year if there's a capability to spend. Usually TurboTax, everybody relies on the have you invested in X, Y, and Z. It's worthwhile to take a look at that now. And then secondly, for the 1 or 2 Texas Rangers fans out there, congratulations on the World Series win late last evening. So with that being said, as Megan mentioned, thankfully, and I would say thankfully because it hasn't been extended yet, and I say yet, is the state and local tax deduction is sunsetting as of the end of 2025. And pass-through entity taxes were imposed essentially to get around that cap. With that being said, we're still there in 2023. So the question is, do you have a partnership interest and have you gotten K1s in the past? And really the focus here is from a year-end perspective, where do you file? and then finding out sort of what K1s you're expecting to get, and reaching out in advance of actually getting them around extension time, which is always crazy for everybody. Really figuring out what K1s you expect to get and what state source income it's going to look like, and if they're actually utilizing a pass-through entity tax or not. Some states allow you to just say pass-through entity tax takes care of everything. Other states don't, and if they don't, there's a question of, is there a composite return filing? If there's a composite return filing, do you have to opt in or opt out, depending on what your particular tax situation is? So it's something to reach out to the provider that you've received K1s from in the past, to reach out earlier rather than later, because what ends up happening is that, again, extension time hits, you get a projected K1, you have no idea what's going on, and there's a lot of concerns around that. And the concerns really focused, again, on, is there actually a pass-through entity tax that's going to be utilized or can be utilized? And then secondarily, what does it actually mean? Taking Connecticut, my home state, as an example, you only get a credit for 87.5%, so you have to make up that differential somewhere. And that's either a composite return or you have to file your own return. So really understanding what your filing profile is really going to be the key. And then secondarily, really determining if you've been doing safe harbor for estimates pre-extension time, and this is about the time to start reaching out, whether it be November, December timeframe, is really to find out if you had anything that you owned if there was a transaction that took place. We've had a lot of surprises, and not in a good way, between initial K1 draft estimates coming out for extension time versus what actually comes through between then and when the actual return is due. So we always tell folks that the easiest way and the best way is to reach out to those K1s that you're receiving and say, hey, was there anything that happened today should be made aware of? Is there a larger item or a larger amount or something that you haven't quite calculated yet that you're just trying to push out a K1 out the door before we really know what the implications are? So the K1 trap, that is the trap. What's your K1 going to look like, and what's it going to look like in March versus what it looks like in August or September? That's what I'll say is sort of on the pass-through entity side. If you own a partnership, if you run one, if you're an active partner, if you're a passive partner. The next area really is becoming, I would say, we'll talk about this at length, and it's down below in the audits and a little bit later on, is really state W-4 issues. So W-4 issues, where are you actually being withheld upon? With the work from home advent over the past few years now, obviously sort of, I'll use the term lately post-COVID, where you work is somewhat a little bit less connected to where you're required to work. We've had a lot of clients on the individual side and on the business side trying to figure out, first of all, where do I file, how do I file, and where's my actual withholding being done? So we tell folks this is the right time. And again, for 23, so the cat's out of the bag already. We're in November at this point. Whatever you've got, you got to hope for the best and hope that your credit for taxes paid takes care of it. But it's one that, especially now, to look at 2024, where are you going to be? And do you want to update your W-4 with your employer if you're a W-2 employee? Or secondarily, looking at your filing profile for 23 with the understanding that you can look at your pay stub online and figure out where's the withholding being done, and am I going to have a cash shortfall, and what do I need to do about it? Again, the surprises that take place, and I would say, for example, from a withholding standpoint in New York, you don't want that surprise coming through later on. Especially yours convenience to the employer rule. No one wants to hear about it. New York and New Jersey are fighting right now, which everybody is, if you're not aware of, New Jersey and New York are fighting. Who gets to withhold on what? And I have a distinct feeling that the 2023 returns are going to be a struggle. So with that being said, the other part that I want to always mention, because I always do, because it's near and dear to my heart, from the personal property tax returns that were due yesterday in Connecticut, which I hope everybody filed if you had them. If you also have real property valuation, whether it's at the commercial or the individual side of things, if you're in a 5 or 10 year reval, administratively, with property values going up the way they've gone up with inflation over the last number of years, if you happen to be in a jurisdiction, and this is obviously much more local, if you're in a local jurisdiction that's doing a reval, keep an eye out. Administrative deadlines are a tough one. If you have an appraiser, if you have somebody to back you up, it's always worthwhile to appeal that. And I say that from the individual homeowner's perspective. The expectation is that if you're in a 5-year reval compared to 5 years ago to today, there's going to be a significant change there. And it's something to keep in mind as you move forward through the end of this year for those appeal deadlines. So the next portion are really on the audit side. On the audit side, I put down 2 of the main ones that we all enjoy in our firm. Customs and Border Patrol, or CBP. As of late, New York and a couple states on the eastern seaboard have gotten a lot better. and started to send out automatic notices that say, hey, you declared X, Y, and Z when you came into the country. And traditionally, the vast majority of this is from sort of the Far East and from Europe. They say you came in and you filled out that lovely form when everybody who's traveled internationally knows when you come on, when you come home, do you have to declare anything? You check the box yes or no. If you check the box yes, the question is, okay, if you bought art, for example, in Europe, did you pay use tax in the US? So on your 1040, as you sit down, whether it's on the preparation side for your own or someone else, there's always that line item that says, do you have use tax to report? States are getting much more aggressive, and this is much more in what I would say no one's worried if you brought back $100 worth of something, but if you brought back art, if you brought back heirlooms, if you brought back something else that you purchased, there's an automatic notice that's getting generated now, and it says based on your declaration for the Customs and Border Patrol, as of this date, you declared X, Y, and Z with an estimated value of whatever that value happens to be. Did you pay use tax on it? So it's one of those lines in the 1040 that nobody ever really paid attention to, especially if you're in Massachusetts going to New Hampshire to buy a TV. But now, for example, it's a much bigger issue, and the dollars we're seeing there and the aggressiveness is much more significant. And you've essentially admitted guilt the moment that you file your declaration when you come into the state. So not saying anything to be done to shield what you're buying elsewhere, but just keep an eye on that. If you are coming back, make sure you report it. It's administratively a pain. And there's obviously penalties and interest attached to that. And then the other one, which we're going to talk about in length in a few minutes, is the residency. I call it, also known as the exit tax. This is an area from an audit perspective that has, I would say, at least tripled over the past 5 to 10 years. And that is sort of related to a few different things, one of which obviously being the ability to work from home and the ability to work essentially wherever you want. And secondarily, to have somewhat of a transitory existence. And I'm not talking about sort of the van life folks out there, which they are, and more power to you. This is really a, where do you put roots down, and what does that mean from a state and local tax perspective? And then lastly, on the budget side, I would say it really becomes and we're talking about a couple of states in particular about what changed. It's been a busy budget year, and the expectation is that it continues. One of the things that states get much more active about is when there's an expected recession or expected depression, whatever you want to call it, an expected slowdown at some point in the near future, exclusive of the 4.9% GDP that just came out. The idea is that when revenue starts to dry up, there's going to be a lot of things that take place to say, how can the state maintain or extend any of their benefits that they've been doing? And that's on, obviously through an increase in the budget, and that budget is funded by taxpayers. So our idea is that besides the New York and New Jersey withholding discussion, there's going to be a lot more when it comes up if things start to go sort of sideways, or if they actually do get inflation under control, that states are going to start to see some of those revenue streams dry up a little bit, especially in the cap gains space. And as a consequence of that, they're going to start to sort of do similar to what Massachusetts did, but start to look at different sources of revenue. So next slide, please. So for Connecticut, just want to highlight a few of the changes that took place for sort of very recently and try to carve this out into the individual pieces that may be of interest. The pass-through entity tax in Connecticut, back when it was first founded in sort of 2018, it was always mandatory, and they were the only state out there that did that. Now they've actually passed through that it's going to be optional beginning in 2024, which ironically enough, as Megan mentioned, that the state and local tax cap sort of sunsets in the end of 2025. There are only 2 states currently, Massachusetts being one of them, that sunsets the pass-through entity tax if the SALT cap goes away. Everywhere else, there's nothing statutory that will make the pass-through entity tax go away. So there will be a definitive exercise that takes place at some point if it truly does sunset, what the actual calculation looks like. Does pass-through entity tax work for you, or exclusive of the standard deduction? If the SALT cap goes away, do you itemize? So that's sort of a big it's sort of the train coming down the tracks in the distance. It is coming. The question is, are you going to have to make a sort of an option A being PTET or option B being itemized if the cap goes away? So also the credit I mentioned earlier that it remains at 87.5. So you've got to make up that differential somewhere, which is why I was saying on the K1 front, make sure you're going to get a questionnaire or a listing that says, hey, here are the composite return states. Here's where we're going to file. Connecticut has an offsetting quasi composite return that makes up that difference, so you don't have to file a non-resident 1040. So something to keep an eye out from a filing profile, just very high level. whether it's Connecticut or elsewhere, it's easy to sort of sit down and say, it's the same as last year, we're going to do the same thing regardless. It's very worthwhile at this point in time, especially when you have a little bit of time to figure out, do you need to make a quarter, a Q4 estimated payment? Or are you looking at my filing profile change drastically year over year? Otherwise, Connecticut put through some credit increases, the earned income tax credit, which is obviously you can see here up comparatively to the federal, and then the angel investor credit, which was obviously essentially I say quasi-state venture capital, when you could actually invest within certain items and get a credit for it. It's being phased out now. Cannabis businesses, there was a capability there for a period of time. Connecticut, other than making everything illegal, was a little bit apprehensive about the state credit side, so they put that a little bit further ahead, being July 1st of this year, a few months back, versus July 1st of 28 for all other industries. So if there is someone looking, whether it's a charitable contribution deduction or getting that credit for Connecticut, if you've got a resident, it may be worthwhile looking at for the next couple of years, especially from a long-term planning perspective. In the interest of rate relief, you could see here that they try to do what I'll call, and I would use air quotes if I could, but they sort of bumped down the lowest two rates. And that phase out was more so it was an acquiescence within the state Senate and the state legislature just in general, the House and the Senate, to give some sort of tax break. This was really politically motivated, and you can see it's not a huge differential, but for some folks it's valuable and worthwhile. But if you look at sort of the overall initial rate deduction or rate reduction they were looking at compared to where they ended up, this was, and I hesitate to say a compromise, but they were really looking for, ultimately this was more of a political move than anything else. So it helps some folks, but really at a lower income rate than some of the larger 1040s that you will see. And lastly, and I put the chart in here, and I don't want to go to the next slide yet, but there was once upon a time you could deduct certain IRA and pension annuity income, IRA distributions. And what Connecticut finally did is they said, hey, instead of sort of having a one-stop shop, we're going to allow you to deduct it or not. They put in a phase out. So if you go to the next slide, I just, for ease of use, I put in the just the phase out. This is right from Connecticut, the General Assembly. And this was really more so to say, this is 2024 tax year. So if you're looking at trying to do some planning around that, if there's a way to reduce AGI, so some of the federal items that Richelle and Megan mentioned earlier, it may be worthwhile because you can see this deduction. Obviously, it phases out once you're at single over 100,000 or married filing joint over 150, but there is some benefit here to that deduction. So if you can do some AGI planning around that, especially with shedding losses, et cetera, it may be worthwhile from a dollars perspective. So next slide, please. So Massachusetts, and a couple of quick things to mention very upfront is the IRS obviously had some disaster relief due to Hurricane Lee. You have an extension from post-September through the end of the year to 2/15 of 24. That's one that it's automatically generated. However, if you do have a problem, there's a disaster relief phone number at the IRS you can call directly if you happen to get a notice, and that's 866-562-5227. It's published out there, and it's worthwhile, especially if somebody's been impacted significantly by that hurricane. Just as sort of a highlight, there's some portions of Massachusetts, some counties, and Maine as well. The next one down is just, again, an opportunity, and I say opportunity from the standpoint of the Massachusetts CDC, not the Center for Disease Control, but the Community Development. They have a community investment tax credit. And what it is, it's a refundable credit, and there's a 5-year carry forward. If you have a cash contribution over $1,000 to certain investment projects, you can get a 50% credit. There are some absolutely worthwhile causes there, and if you've got some cash that you'd like to park somewhere and get a benefit for it, there's a list of prior distributions / disbursements that you can actually see some of the projects that went to. It's raised about 80 million or 85 million since 2014. There's over 50 state community development projects that you can look at there. Definitely worth a look, especially if you've got some cash that you're looking for, not only the charitable contribution on the federal side, but a possibility of a Massachusetts tax credit. So moving on to some of the changes Massachusetts had, we have a thought leadership out. Go back, please. To go back through, we have an article we put out on this for pass-through entity tax for Massachusetts. As I mentioned earlier, that is actually bolted on to the federal, state, and local tax cap. So depending on what happens over the next couple of years, that could essentially go away. The second piece really is, does the millionaire's tax apply? Currently, Massachusetts has out there's a study that's going to be done, and that study really relates to, should the pass-through entity tax be at 5% or should it be at 9%, including a 4% surtax? That study is to be continued. For now, everything's status quo, but that is a question of, if you have, for example, pass-through entity tax that you have a disbursement or income over $1 million, you individually will have to pick up that difference versus the pass-through entity tax only picking up 5%. So again, the idea there is there going to be some mechanism in there to take care of that other than you having to file a return? Again, to be continued, but keep an eye out for it. There was legislative activity to try to make that happen. And then on the credit front, and again, very similarly to Connecticut, the earned income tax credit is up from 30% to 40% of the federal earned income tax credit. So helping out the folks in that sort of income strata. The child tax credit, obviously it went up in 2023 and up to 2024, goes up to $440. Something to keep in mind, and every dollar helps. And the last two are a little bit, I would say, less common, but something that's out there is that there's a senior circuit breaker credit for upgrades to some electrical systems. It's been doubled from $1,200 to $2,400, obviously with the substantiation behind that. And then lastly, on the septic tank replacement and repair, obviously there's some environmental concerns there. That credit's been now increased to $18,000. That's got extensive requirements for record keeping. So I always tell folks, if you are going for that, take a look at it, and before you get through that process, most of the providers of that service will have some indication of what that looks like. I always tell people, do your due diligence. If you happen to be replacing a septic tank or repairing it, take a look, because you can at least mitigate some of that upfront cost. So next on the list, which is a huge one for folks, the short-term capital gains reduction for 2023 is 12%, down to 8.5%. So it's obviously baked into the form, but something to take a view to in the last couple months of the year. If there's something you can pick up a capital gain, get a little bit less of a detriment in Massachusetts. So lastly, some on the other front, and I say other from the standpoint it's still important. The estate tax starts at $2 million. So the old rule of an estate with $1 million in assets, everything was subject to tax. Now they've said, hey, $2 million and only amounts above that. And that's essentially an offsetting credit. So that's a huge change in Massachusetts that's been coming for a long period of time, but it's one that sort of came to focus and they finally passed it. Next, and this is from a millionaire's tax standpoint from up above, the federal filing joint. If you federal married filing joint soon requires a joint, married filing joint in Massachusetts. The idea here was that people were saying, hey, if I've got a millionaire's tax, that 4% surtax, if I file separately, where two folks are below it, if we file married filing joint, we're above it. So the workaround was we file separately, and guess what? We end up net benefit, although there's the marriage tax sort of consequences there. The idea being you actually had a workaround. So for 2023, that still exists. For 2024, that no longer exists. So they couldn't pass it in time. So if you've got somebody who happens to combine to be over $1 million of income, it's worth a while to look at that. Even if you've got a system spitting out, there's a married filing separate detriment in a particular state, Massachusetts wouldn't fall under that. The last few quick items is the rental deduction cap, and this was a deduction for obviously renters in Massachusetts to alleviate some of the housing issues. It raised to $4,000 from $3,000. There is a significant amount of other housing credits. So if you have anybody who's in a lower income bracket and looking for housing credits, it's worthwhile. There's a lot of increased funding that took place over the last 6 months there. The deduction, the 280C deduction, cannabis businesses, Massachusetts now conforms to say 280C sort of goes away. You can take your regular deductions under 163 and 280C goes away for that standpoint. And lastly, just something to mention, very high level, there's currently in the works right now, Governor Healy came out with an idea that there's a $4 billion housing need. And there's currently in the works that there will be a local option real estate tax. That local option real estate tax would fund that $4 billion to work towards affordable housing. So that's a to be continued, but something to keep an eye on, looping back to when you've got your revals, keep an eye to, there's a possibility you could have another layer of tax on that. Next slide, please. Do New York quick and then get to the meat of the residency issues. So New York, somewhat of a quiet front on the individual side. The ITC refundable for farmers, obviously upstate, there's some folks that took a benefit there. And then on the pass-through entity tax side, just to keep an eye out, if you happen to have a partnership that's doing business there, you had to do an election by the 2024 by the Q1 estimated due date, or by 2023. So either you're in or out by this point. So keep an eye to the pass-through entity tax. And then taxable income, there was a circular calculation issue in New York and New York City, but now there's not. Taxable income includes any pass-through income entity tax you paid. There's no circular between, well, if we deduct it, and we sort of get in that same loop. We deduct it, but then our net income is what we base our tax on, et cetera, et cetera. So with that, I'll turn it back over to Richelle for our residency discussion. Next slide, thank you. Oh, sorry, polling question, my apologies.
First.
The tax-free state, and I'll tell you after we get the results back where we've had most folks move to. But I'll say for me,
you are seeing a lot of people move, Nick.
I would say, listen, for me, it's big sky country in Montana.
Okay. Yeah, the one thing I would note on the pass-through entity taxes you were talking about, Nick, is that I could see even if the limit went away, there's sort of a practical advantage to it, right? Of the partnership handling the tax bill, especially if you're operating in a number of states, that sort of simplifies the overall process for partners.
Yeah, and the idea was always, at a certain point in time, yes, I would agree with you. I mean, the question is always, it goes hand in hand with composite returns. If you've got the capability to do composite return, it's a question of shifting the deduction. So yes, I agree. I think pass-through tax will be around forever. I don't think it will go away if the state and local tax cap goes away. I think there is a practical aspect of people don't want to file 15 or 20 returns. So yes, I would agree with that wholeheartedly. Oh, we got results. There you go, Florida. You're in line with pretty much everybody else that we've been seeing with clients. So with that, I'll shift it over to Richelle, and we can talk through residency.
Thanks, Nick. Yeah, so as Nick mentioned, I mean, starting with the pandemic, we've certainly been getting questions about changing residency much more frequently. And up in Massachusetts, with the changing tax laws, the mass millionaires tax coming into play, the estate tax provisions, there's been a lot of questions, and we're seeing a lot of people looking to move out of the state, sadly. So, you know, basically the thing that we provide to our clients and the discussions that we have is kind of revolves around giving them this kind of checklist, and nothing is bulletproof. There's no one factor determinative of your residency, but we look at, you know, kind of the big things. So, you know, making sure that, you know, sell your home in your current state, buy a new home in the new state, or if you're not going to purchase property, sign a long-term lease. Short-term seasonal leases are not going to cut it. Obviously, spend time in that new state, and if possible, keep a log of your time there and your time traveling. You know, change your registration to vote to your new state, and actually do vote in your new state when you have the opportunity. Use your new address and all your legal documents, tax returns, bank statements, investment statements, you name it. Update your insurance to make sure that you list where your physical property is in that new state. Cancel your memberships to country clubs and churches and synagogues and whatever other organizations you might be part of, and join new ones in your new location. Consider changing your physician and your dentist and actually having your records transferred to them. You know, other things as far as estate planning, update your will, you know, in some cases, change your burial plans, close your safe deposit boxes and transfer them to your new location. So all these facts and circumstances come into play in a residency audit, and they are extremely time consuming. They are extremely intrusive. When they come in to do a residency audit, they're asking for bank statements, phone records, credit card statements. They're looking at everything. And the more you have to support your position that you have truly moved to this new state and this is your home, the better position you'll be in. But you know, it does come up a lot. We're seeing a lot of shifting around. It's always been an issue, but I think that between COVID and people moving around so much, I think we're going to be seeing a lot more residency audits in the upcoming years. We're just starting to see audits for 2020 as the statute is coming to an expiration. So, that's when we saw a lot of this movement happening. So I anticipate that we're going to be seeing a lot more of these coming to pass.
Yeah,
Would you agree?
Yeah. I'll just add in that there's two pieces of it, and you're absolutely correct. The other piece is to make sure, and this happens a lot in the deferred comp space, is really keep an eye towards special accruals. So New York has been notorious for that as of late. So if you are changing residency, it's looking at where the income was earned versus where it's dispersed. So yes, the residency audits are significant. Phone records, credit cards, your whole life will be under a microscope for the year of change. And I tell folks that there's always sort of the period you don't want to move. And there are two parts of the year that you don't want to move. From, I'd say, October 15th through 12/31 and January 1st through February 20th. Because the moment you move sort of the very beginning or the very end of the year, it's going to have a higher level of scrutiny.
I was often someone had a question about, if I have 6 months in one and 6 months in the other, how does that work? And well, the answer there is really just it's going to be more complicated than that, right?
Yeah, so there's a couple pieces there. I don't want to I know we got another couple of slides and we're getting close on time, but the issue there is there's residency from a domicile perspective and there's residency from a statutory residency standpoint. So in theory, most states, if you spend over 183 days and you're a statutory resident, you would have to file as if you're a full year resident. Domiciled residency is where you intend to stay, it's permanent, et cetera. So there's no requirement for 183 days. So you could be a true domicile resident, you moved on November 15th. However, your prior state may say if you had a permanent place of abode there, if you really, really left, maybe you won't have to do a full year resident return. However, you can have a situation where you could have that dual residency. So yes, if you have 6 months in one, 6 months in the other, it will be more complicated. You want to do a day count and then figure out what do we actually want to file and what's going to get scrutinized. So a diary, day count, day log that Richelle was mentioning, absolutely. I'd recommend to anybody who's has the capability to do that, to track that, because most auditors will ask for your cell phone records or they'll subpoena it, and it will look at the closest cell phone tower that you pinged off of. So just be aware.
Great, next slide. Actually, one more. So basically, we hope you take away from today that tax planning can create significant savings. It is crucial to seek advice prior to action, because once you've done something, it's almost impossible to undo it. And proactive planning is key, especially in the upcoming 2 years as we're looking at tax provisions expiring. You can't wait till the last minute to act, because you're not going to be able to act in time. So definitely keep those proactive conversations happening, proactive planning before year end, and as we move through the next 2 years. Next slide. We are coming to the end. Chris, do we have any other questions out there?
We do have one that I'll briefly mention about sale of property abroad. If you're a U.S. person that owns property abroad, the thing that I always remind people, this is worldwide taxation. Keep that in mind. Just because the property is somewhere else doesn't mean that you're not going to have tax on it. Even if you have an entity between it. In fact, you're probably going to need to report that entity that's holding it. You may be able to get a foreign tax credit to offset the income, and that's another sort of conversation that you should have with your advisor. But my big takeaway is if you own property abroad, either through an entity or in your name, make sure your advisor knows that. Make sure they're able, you having that conversation with them so that they can do appropriate planning and they're not caught flat-footed when you say, oh yeah, I'm selling my residence in Italy. And you're like, well, I didn't know you had a residence in Italy and we missed reporting for the last 5 years because of it. So note that.
I'll second that. I had someone that when I was doing their return mentioned, oh yeah, I sold a small property in Spain. That small property was not small by any means, but for them, it's just you get whipsawed. So it's something, facts are important. So obviously make sure that your advisor, you let them know before you actually have the sale. It's worthwhile.
Absolutely. We're at 10:30.
Timing's everything.
All right, that concludes our webinar for today. Thank you to our speakers and thank you everyone for attending. Please remember to complete the short survey prompted at the close of this webinar. Again, as a reminder, a recording of today's webinar and a copy of the PowerPoint slides will be made available to all attendees via email within the next few hours. Again, CPE certificates will be issued within 8 to 10 days via email. Thank you again and have a great rest of your day.
Thanks.
Thank you.
Thanks, everybody.